Investing can feel complicated. There are thousands of stocks to choose from. News channels shout about the next big thing. It is easy to feel lost. It is also easy to guess. But guessing with your money is not a good plan. A better way is to understand risk. Not everyone can handle the same amount of risk. Some people need their money to be very safe. They are saving for a near-term goal, like a house down payment. Others have a longer timeline. They can afford to take more chances for a bigger reward. This essay will help you understand these differences. We will sort stocks into clear groups. The goal is to stop guessing. We will create a simple framework. This framework uses 3 risk levels: low, medium, high. For each level, we will give clear examples of company types. We will explain why they belong in that group. This will help you see the logic behind the choices. It is not about picking one perfect stock. It is about building a collection of stocks that matches your comfort level and your financial goals. Your friend's hot stock tip might be a terrible fit for you. Your plan should be built for your life, not someone else's. This guide is for everyday investors. The language is simple. The sentences are short. We will avoid jargon and confusing terms. Low-risk stocks are the bedrock of a solid investment plan. They are designed for capital preservation first and growth second. This means their main job is to protect the money you have already saved. They are not meant to make you rich overnight. Instead, they provide slow and steady growth over long periods. These are the kinds of investments that help you sleep well at night. You do not need to check their prices every day. Their value does not usually swing wildly up and down. For investors who are cautious or who have a shorter time until they need their money, these stocks are essential. The companies in this category are often household names. They are large, established, and have a long history of stable performance. Think of businesses that sell products or services that people need no matter what the economy is doing. These companies have predictable revenues and profits. They are often leaders in their industries with strong competitive advantages that are hard for smaller rivals to overcome. Because of their size and stability, they can weather economic downturns better than smaller, more fragile companies. They are like a sturdy ship in a storm, moving slowly but surely toward their destination. Another key feature of many low-risk investments is their ability to generate income. Many of these companies pay dividends. A dividend is a small cash payment that the company shares with its owners, the stockholders. These payments provide a steady stream of returns, even if the stock's price is not moving much. This predictable income can be a great comfort during volatile market periods. It adds a layer of stability to your portfolio. Over many years, reinvesting these dividends can also significantly boost your total returns, letting your investment compound and grow more powerfully. So, why choose low-risk stocks? You choose them for peace of mind. You choose them for stability. They are less likely to suffer catastrophic losses from which it is hard to recover. While their returns might seem boring compared to high-flying tech stocks, they play a crucial role. The S&P 500 has returned about 14.6% per year over the last decade, but it comes with volatility. Low-risk stocks, like the dividend aristocrats, have shown they can deliver solid returns with lower risk. They are the foundation upon which you can build the rest of your portfolio, adding riskier assets in careful measure. First, let's look at mega-cap leaders. These are the largest companies in the world. Think of a retail giant like Lowe's. Founded in 1921, it has a very long track record of success. This creates a steady demand for its products. They have enormous resources, strong brand recognition, diversified business operations. Their size makes them very resilient. They can borrow money cheaply, invest heavily in new technology, outlast smaller competitors during recessions. Investing in a mega-cap leader is like betting on a proven champion. The growth may be slow, but it is often very reliable. Second, we have the dividend aristocrats. These are a special group of companies. To be on this list, an S&P 500 company must have increased its dividend payment for at least 25 consecutive years. This is a very high bar. It proves a durable business model that can generate growing profits through all economic cycles. Nucor, a steel producer. Pentair, which works in water solutions. According to TipRanks, analysts have a strong buy consensus on Pentair. These firms are disciplined with their cash and committed to rewarding shareholders. Third, there is broad index exposure through an exchange-traded fund, an ETF. An ETF that tracks the S&P 500. An ETF that tracks the dividend aristocrats like Nobiel. It's a simple way to achieve diversification. Instead of buying one stock, you are buying a small piece of hundreds of companies at once. This automatically spreads out your risk. If one company performs poorly, it has a very small impact on your overall investment. Historically, dividend aristocrat funds have performed well with lower volatility than the broader market. For many people, a low-cost, broad market index fund is the single best and simplest way to start investing with low risk. These three examples share common traits: stability, diversification, proven performance. They will not deliver explosive gains in a short period. That is not their purpose. Their function is to anchor your portfolio and protect your capital while still allowing it to grow at a reasonable rate over the long term. They are the ideal starting point for a new investor and should remain a core part of any balanced portfolio, regardless of how much risk you take elsewhere. Slow, steady, sensible. It's the slow, steady, and sensible path to building wealth. Once you have a solid low-risk foundation, you might want to seek higher returns. This is where medium-risk stocks come in. These investments offer greater potential for growth than low-risk counterparts. But with higher potential comes more uncertainty and volatility. Prices can move up and down more dramatically. These are not bets on unproven ideas. They are typically established companies in a phase of strong growth, or companies investing heavily for future expansion. They offer a balance for investors willing to accept bumps for better long-term outcomes. What does a medium-risk company look like? Often a well-known business using profits to innovate and expand. A technology leader pouring money into R&D instead of dividends. These companies are betting on their future success. They reinvest cash into creating new products, entering new markets, building out new technologies like artificial intelligence. That strategy can lead to significant share price appreciation if bets pay off. The risk is controlled but still present. Success is not guaranteed. A new product could fail to gain traction. A competitor could release a better technology. Economic conditions could change, making funding growth harder. That's why their stock prices are more volatile. The market constantly reevaluates their chances. For investors, this means a longer time horizon. Be prepared to hold these stocks for several years to let growth stories play out, riding the ups and downs. Choosing medium-risk stocks suits investors with basic needs, covered who want faster wealth growth over a 5 to 10-year period. It's a step up on the risk ladder, but a calculated one. You're not speculating on a tiny unknown company. You're investing in a strong, established player working to get bigger and more profitable. This middle ground offers a chance for enhanced returns without exposing your entire portfolio to extreme speculative risks. A great example of a medium-risk investment is an established tech leader that is reinvesting its profits heavily. Consider a company like Amazon. It has a dominant and profitable position in e-commerce. It also leads in cloud computing. Instead of paying a large dividend, it pours billions into new growth areas, including artificial intelligence. As noted by Motley Fool, Amazon is investing in AI to enhance its businesses, making it a strong player for the long term. You get the stability of core operations combined with growth potential from new tech. The risk is, these big investments take time to pay off, creating uncertainty. Another medium-risk category: companies providing infrastructure for major tech shifts. The AI market is expected to grow from $235 billion in 2024 to over $631 billion by 2028. A company like Advanced Micro Devices, AMD, is a key player here. It designs powerful semiconductor chips essential for data centers and AI applications. Morningstar analysis suggests AMD is well-positioned to benefit from AI trends and may even be undervalued. It competes fiercely with NVIDIA, but its position in a fast-growing market gives upside. The risk: tech cycles and intense competition. A third example: a global brand expanding profit margins. Consider Mercado Libre, dominant in Latin American e-commerce and fintech. It has a powerful flywheel where its units support each other. After a recent price dip, Motley Fool still calls it a favorite growth stock. It's established but still in high growth mode, expanding services and improving efficiency. The risk, operating in emerging markets, which can be more volatile. But leadership provides a buffer, placing it in the medium risk category. Amazon, AMD, Mercado Libre each is a step up from a dividend-paying utility company. They are not guaranteed winners. Their success depends on continued innovation, smart execution, and favorable market trends. They are not wild guesses. They are strong, leading companies with clear growth strategies. For an investor with a timeline of several years, these offer a way to seek higher returns. Now we arrive at the top of the risk ladder: high-risk stocks. These are the investments that can generate spectacular returns, sometimes multiplying your money in a short period. However, they carry an equally spectacular risk of loss. Many of these companies will fail. Their stocks can go to zero. For this reason, you must approach this area with extreme caution and a clear set of rules. This is not the place for your retirement savings or your emergency fund. This is for a small portion of your portfolio that you can afford to lose entirely. It is speculative money. The first and most important rule is to keep your position sizes small. Never go all in on a single high-risk idea, no matter how convincing the story sounds. A good guideline is to allocate no more than 1% to 5% of your total portfolio to any single speculative stock. By keeping the bet small, you cap your potential losses. If the stock fails, the damage to your overall financial picture is minimal and manageable. If the stock succeeds wildly, even a small position can still provide a meaningful boost to your portfolio. This discipline is the key to surviving the inevitable losses that come with high-risk investing. The second rule is to look for a clear path to profitability. Many high-risk companies are small and not yet profitable. Odds are better with companies that are at least generating real revenue and have a credible plan to make money in the future. A company that is already profitable, even if it is small, has proven its business model works. An example is Kinsale Capital Group, a specialty insurance company that has carved out a profitable niche by taking on risks that larger insurers avoid. As Motley Fool notes, its impressive revenue growth and superior profitability make it a smarter high-risk play. The third rule is to be intentional, not emotional. High-risk stocks are often surrounded by hype and excitement. It is easy to get caught up in the fear of missing out and buy at the top of a bubble. To avoid this, have a plan before you buy. Know why you are buying the stock, what price you think it is worth, and at what point you would sell, either to take profits or to cut your losses. Write these points down. One category of high-risk investments is emerging technology leaders in speculative fields. Think of quantum computing or space exploration. These industries have massive potential but are still in their very early stages. Rocket Lab is a company in the space industry. McKinsey projects the space economy could triple to $1.8 trillion by 2035. Rocket Lab is a key player, but with a market cap of only $28 billion, it is a small fish in a potentially huge pond. Another example is Rigetti Computing, RGTI, which works on quantum computers. 24/7. Wall St calls it extremely speculative. These companies could become giants, or their technology could be unworkable or unprofitable, making the stocks worthless. Another high-risk area is small-cap growth companies that are not yet profitable. Sweetgreen, the fast casual salad chain, is an example. It has strong sales at its existing locations, but is still a very small chain with only 266 locations. It must spend heavily to grow, which means it is not yet profitable. Another example is Ava, a tech company. The risk is immense. These companies can burn through their cash before reaching profitability, especially if interest rates are high or a recession hits. A third high-risk example is a turnaround story, or a company in a highly cyclical industry. These are companies that have fallen on hard times and are attempting a comeback, or businesses whose profits swing wildly with the economic cycle. For instance, a small oil exploration company or a biotech firm awaiting FDA approval for its only drug would fit here. Their fate rests on a single binary event or on external factors they cannot control, like commodity prices. Success can lead to a massive stock price jump, but failure is common and often total. This is all-or-nothing investing and should be handled with the smallest of position sizes. These examples, emerging tech, unprofitable small caps, and turnaround stories, all share a common thread: a wide range of possible outcomes. They have the potential for life-changing returns. We have walked through the 3 levels of risk. We have looked at examples for each. Now it is time to bring it all together into a plan that works for you. Investing successfully is less about finding the perfect stock and more about building a portfolio that matches your personal situation. Before you buy a single share, you need to be honest with yourself. The best way to do this is to go through a simple checklist. This final step will help you turn these ideas into action and build a portfolio that you can stick with for the long run. First, ask yourself, what are my financial goals? Are you saving for a down payment on a house in 3 years? Are you investing for retirement in 30 years? Or are you trying to generate some extra income right now? Your specific goal is the most important factor in determining how much risk you should take. A short-term goal requires a very low-risk approach. You do not have time to recover from a market downturn. A long-term goal allows more medium and high-risk investments. You have decades to ride out the volatility. Second, consider your timeline and your discipline. Your timeline is connected to your goals. The longer your money can stay invested, the more risk you can comfortably take. Discipline is about your personality. Can you ignore the daily noise of the market? Will you panic and sell everything if your portfolio drops by 20%? If you are likely to react emotionally to market swings, build a more conservative, low-risk portfolio. A plan is only good if you can stick with it. Be honest about your own temperament. Finally, use this self-knowledge to build a balanced allocation. You can mix and match the risk levels. Conservative example, 80% low risk, 15% medium risk, 5% high risk. Aggressive example, 20% low risk, 50% medium risk, 30% high risk. These are just examples. The right mix is personal. Start with a foundation of low-risk index funds and dividend payers. Then, layer in some medium-risk growth stocks. And only then, if you choose, sprinkle in a few small, high-risk bets. Not everyone has the same risk tolerance, so let's break this down the smart way. The best stock right now is the one that fits your goals, your timeline, your discipline. That's investing done right. You can make good decisions with your money. You just need a clear plan.